Hi, Michael Glennon from Glennon Capital. People always ask me what I know about property. I always say I don't know a lot about property. I like the equity market. I don't like the characteristics. I don't like the returns that you get as an owner in terms of yield that you get on property. And I think there's a worrying trend that the level of appreciation in both commercial office space and residential office space has increased significantly over the last few years. So there's an interesting survey out this week by the household income and labour dynamics, and what that actually shows is that for the percentage of the population that's under 40, their level of home ownership has decreased dramatically since 2002. So back in 2002, just under 40% of people under 40 own their own homes. That has decreased in 2014 to 25%. So property is getting very expensive. Young people just can't afford to buy property. I don't think it's a lifestyle choice that they make. I think a lot of them would like to own property but find it unaffordable. But more worrying is that the level of equity in home loans has decreased, while at the same time the level of indebtedness has doubled. So for that under 40 group, the average mortgage back in 2002 was about $170,000. That has increased to nearly $340,000, and people have less equity in their homes. So it's a worrying trend. I don't think it's a great place to be. I'm obviously an advocate of the equity market, but the wider implication for that is that while those people are struggling to afford houses at a point in time where asset prices are very high because interest rates are low, if we do get interest rate increases, people are drawing back against their mortgages. There's more statistics out this week against that. It's going to mean that there's dire times for the retail sector in Australia, and you add to that the Amazon effect, which has been very widely publicised recently. So we're not a fan of residential property at these levels. We're not a fan of the retail sector. We're very worried about the Australian consumer, so we are positioning our portfolio away from those categories. And I'd be cautious about anyone investing in residential property at this point in time in the cycle, as well as drawing back off your mortgage and becoming further indebted in light of the fact that we are at all-time low interest rates. So serviceability is going to decrease as interest rates go up, and we may see defaults in property sector. So I'm very cautious about that sector, and I'd encourage most people to really think twice about investing further in residential property, both to live in or as an investment asset. I'm Michael Glennon, and thanks for watching. Because for small companies, quite often you'll see companies where the management and senior executives are paid significantly more than what's appropriate for the size of the business. So a good example, we look at many small companies that have a profit under $1 million. When you add up the total executive remuneration, and it's significantly more than what the company's making in terms of profit, it's a warning sign for us. So